on with the question?
Sure. Yeah, questions can be unrelated to the presentation. If it's about love advice or relationship advice, please don't ask me. I'm not really good with that stuff, but accounting and tax, sure. Weather today, it is freezing outside. I'm not sure if most of you are in the GTA or not, but I do know that it's the coldest day of the year today, and I believe it's minus 30 degrees from what I was reading in the weather report. It's cold. So there's one point from a soon-to-be non-resident. They want info on how the departure or expat tax really works before leaving Canada and becoming a non-resident. So while we'll address that towards the end of the presentation, we'll leave that as the last Q&A item if we can. Okay. We're going to start the presentation. I appreciate all of your patience. And thanks, Hui, for organizing this. Hui will, for those of you who don't know Hui is basically the marketing person at Madan CA, and he helps with our webinars, our marketing materials. And if you've received a thank you note, it's probably because Hui sent you that thank you note, or if you got a birthday reminder, it's because of him. Okay, so just 1 minute and then we'll start the presentation. For those who have just joined, if there are questions, please type it in the chat window at the bottom, and Hui will read out the question and I will answer. We're allotting 30 minutes for the presentation and 15 minutes for Q&A. Email a copy of the presentation to everyone after this. And do we have an audio recording, or were we not able to do that?
Still recording right now.
Okay, so great. Then he'll send out a compressed audio file, or at least a link to it, so that way you guys could access the audio and visual of this presentation. We're about to start in just 1 minute. Okay, just a few seconds. I'm just waiting for Hui to come back here, and we're about to start. We're at 12:05, just a few seconds. So ready, Hui? Okay. Are you ready to go? Okay. So, start please. So the topic of today's session is year-end tax tips for biz owners. And Hui, could we go to the next slide, please? Now, generally speaking, what we try to do is create a tax plan for each of our business owners. And people are great at creating plans for budgets and other aspects of financial management, but they often forget about the tax consequences and fail to prepare a tax plan. So really the slide is getting to the point that you have to take your tax affairs seriously and plan for them before the year starts, so you have a roadmap, and that's what we do for you. Could we go to the next slide, please? Okay. There's a couple of options that you can pay yourself, and I'm going to go through them briefly here. The first option is to pay a salary from the corporation. Now, the benefit of paying a salary is that it's considered earned income for RRSP purposes. That means you can make a contribution to your RSP room, and you will have room available because salary increases your RRSP room. The second advantage of paying a salary is that it is tax deductible to the corporation, so it's an expense. and that reduces the corporation's taxable income. Number 3, with a salary, you have the benefit of contributing to the Canada Pension Plan. Now, some of you don't want to, but others maybe who are want to be avid savers and use the CPP, which the government provides upon retirement, then they should be taking the salary approach, because it's on salary, CPP premiums are payable. Okay, so if you're relying on that pension, or even if you want that pension but you're not relying on it, salary is the way to go for you. Okay. Before we go to the next slide, I did want to mention income splitting with family members through salary. If there is an audit, the first thing the CRA is going to ask is, did you pay a salary to a family member? Okay, and your answer would be, yeah, I did. The next question will be, do you have an employment agreement? Do you have timesheets? How did you determine the rate of pay? Is it reasonable in the circumstance? So that's sort of when the house of cards starts to fall down. You have to plan for paying a salary to a family member. So you should absolutely get an employment agreement. It doesn't have to be fancy. You don't have to pay a lawyer hundreds of dollars. There's many employment agreements available for download on the internet. And as long as it sets out the terms of what the employee will be doing, their rate of pay and their hours, that's generally sufficient. Now, when I say timesheets, there should be timesheets like I get from my employees. We get timesheets, and those timesheets evidence the amount of work that the employee did in the week. The CRA will ask to see those. And the wage has to be reasonable in the circumstance, and I would just try to use the smell test. I mean, you wouldn't pay your nephew who is 14 years old $50 an hour for filing paperwork. Okay, so it has to make sense. Can we go to the next slide, please? This slide is basically going to the disadvantages, and the disadvantages is that salary is taxed at a higher rate than dividends. Okay, and I will talk to dividends in a bit. The corporation is required to pay CPP, and on the one hand, it's an advantage because you're increasing your Canada Pension Plan payout when you retire. On the other hand, it's a pretty significant cost. When you include the employer and the employee portion, it's $4,000. So it's 10% of salary over and above $3,500 to a maximum of $4,000 in a year. If there's 2 shareholders and employees who are husband and wife, that's $8,000. And the Ontario pension plan, I believe, is going to be coming into effect this year, so that's going to be an added cost. There is more administration with payroll. You have to remit source deductions monthly. Source deductions are for income tax and CPP and EI in certain circumstances. Okay, and you have to issue T4 slips. So this can be, a nuisance for you, particularly if you want to reduce your paperwork. Okay, going to the next slide here, which is paying dividends from the corporation. I'm a fan of dividends. I take dividends from my own corporation, and the reason I like dividends is because the first $35,000 of dividends received by a person in Canada is tax-free, providing you have no other source of income. So between my wife and I, we could receive $70,000, which is almost $6,000 per month, completely tax-free. That's great. It's easy, meaning you don't have to worry about source deductions and remitting payroll forms monthly to the CRA. And you save on the CPP premiums, which we talked about being a heavy cost of about $8,000. Could we go to the next slide? Yeah, sure. What's Andrea asking? Cannot family member be treated as subcontractor? That's a good question. I had a client come to me yesterday, and he's being audited. And he did what you're suggesting. And the auditor asked to see copies of all of the invoices, the management agreement, and the register from their cash journal or their accounting system documenting the checks paid. I can tell you why they're asking this. The CRA's position is that that family member is likely not operating in the capacity of an independent contractor, but rather an employee. That's the stance that they're taking, whether you're paying yourself or a family member. Because it makes sense from their standpoint. I mean, if you're their only customer, meaning the family member only works for you in this independent contractor relationship, 9 out of 10 times they really aren't an independent contractor. So what ends up happening upon an audit is that they're going to say, well, we're going to reassess or reclassify these invoice payments or management payments made to the family member as payroll, and Andrea, you as the employer are now going to be on the hook for penalties of about 50% of the payroll that was not deducted, right? Because you have to remit payroll taxes. So not only are you going to be stuck with the payroll taxes, the penalties on top of that are draconian. So I'd strongly recommend against using an invoice scheme for family members. Yeah, we'll just continue on it. There are good questions. I'll try to answer most of them at the end, just because I want to keep it to 30 minutes, but I will answer those questions. Could we go to the next slide, please? Okay. The next slide, we're talking about the disadvantages. The disadvantages are that dividends are not an expense, but that's true, but at the same time, you're paying a very low tax rate when you receive a dividend, so that's why it's not treated as an expense of the corporation. Dividends, as I mentioned, do not increase your RRSP room, and dividends cannot be used as a source of income to deduct childcare expenses. So if you have childcare expenses like PLASP fees, babysitting fees, Montessori, daycare, you should be paying yourself some salary, because those childcare costs can only be deducted on your personal tax return against salary and not dividends. Okay, if we could go to the next slide, please. A mixture of bonus and dividends. If your company is earning more than $500,000 in profit, this is taxable income, revenue minus expenses, then we'll use what's known as the bonus down strategy. And I'll explain why. Let's say that, for instance, your corporation has $800,000 of taxable income. It's a good year. The first $500,000 of taxable income is taxed at the small business rate of 15.5%. That's what we're all accustomed to. But the second tier, which is any taxable income over and above $500,000, is taxed at a whopping 26.5%. So when you look at the corporate tax at 26.5% on that excess taxable income, plus the eventual dividend tax that you'll pay when you withdraw that excess income from the corporation to yourself, you end up paying about 55% in corporate tax and personal tax with respect to taxable income in excess of $500,000. So what do? We pay a bonus to the owner-manager at the year end to reduce the taxable income from a very high amount to $500,000 or below. Okay. Could we go to the next slide, please? I believe we've touched on a couple of these points already, so I'd just like to move on to the next one. Okay, other methods of obtaining funds from the corporation. Capital dividend payments. So there's something known as the capital dividend account, and it's not on the tax return, but you have to maintain like a calculation, or your accountant should, or I should, on a spreadsheet, which calculates the amount of which calculates the balance in your capital dividend account. For those of you who don't know what a capital dividend account is, it's calculated based on the non-taxable portion of any capital gains that you've had since inception. A very good example is that you have some excess cash saved up in the corporation, and you invest that money in stocks within the corporation. And let's say over the last 5 years, your realized capital gains are $100,000 from the sale of stock. You made some good moves. So your capital dividend account now has a balance of $100,000. So a dividend could be paid of $100,000 from the capital dividend account to a shareholder completely tax-free. Okay. Another item that increases the capital dividend account is life insurance proceeds. So if a shareholder dies and the corporation is named as a beneficiary in the policy, the life insurance proceeds paid to the corporation would increase the capital dividend account. That allows the corporation to pay the life insurance proceeds stuck inside the corporation as a tax-free dividend to the estate of the deceased through the capital dividend account. Okay. See here, one thing that isn't mentioned is interest. That's another way to extract funds from the company. So let's say you have mom and dad or another family member who maybe have a lot of cash but are in a low tax bracket. They could lend money to your corporation, and your corporation could pay them interest. That interest would be a tax deduction to the corporation and taxable to your lower income family member. Obviously, you have to have the cash available to make that loan to the corporation in the first place. Okay, if we could go on to the next slide, please. Repay shareholder loan or charge interest as an expense. I often get asked, well, why can't I just take a loan from my company? You know, that would be taxed for a loan. No one pays tax when they receive proceeds from a loan. Well, there's a rule in the Income Tax Act that says that if you receive a loan from your corporation and you're a shareholder of that corporation, the amount of the loan is included in your income for the year, unless you repay the loan within 1 year of the corporation's year end. Let's take an example. Victor takes out a $100,000 loan from his corporation having a year end at December 31st, 2014. And he decides not to repay it in 2015. So now 2015 has passed and Victor blew that $100,000 on gambling in Vegas. And now we're at January 1st, 2016, and poor Victor missed the deadline for repayment. The deadline was 1 year. So had Victor repaid the full $100,000 and not lost that money on gambling by December 31st, 2015, he would not have to pay tax on the $100,000 received. Okay? So bottom line is shareholder loans are taxable to the recipient unless you pay them back in 1 year. Well, one point I'd like to add is that don't use the scheme of borrowing from your company, repaying your company, and then borrowing the same amount again. This is known as a series of loans, and is considered basically an abuse of the Act, such that the original loan that you took would be considered taxable to you in the year that you took it out. Okay. Accrue salary bonus for year end. Again, that's not a bad idea, and there's a 179-day rule. So let's say that your company doesn't have the money right now to pay corporate tax. Okay, if for some reason you spent it on maybe capital asset purchases or reinvesting in your business, and I come and tell you, well, this is your tax bill, and you get upset because you don't have that money available or your corporation doesn't. Consider accruing a bonus. What this means is that a bonus expense is recorded in the financial statements of the corporation, and it becomes a liability on the books of the corporation. So if we think about this conceptually, the corporation hasn't paid the bonus. All they did was book an accounting entry for a bonus expense and a bonus payable. So long as the bonus is paid within 179 days of the corporation's year end to the person who's supposed to get the bonus, it's tax deductible. So this is taking advantage of 6 months of tax deferral. You get a deduction at the corporation level, and the recipient of the bonus doesn't have to pay tax until 6 months later when they actually get the bonus in their hands. Okay?
That's a good question.
Yeah. Does this advice only apply to incorporated businesses? Some of this advice applies to both, but with an incorporated business, you cannot pay yourself a bonus, a salary, or dividends. As a sole proprietor, you are taxed on income as it's earned, and so there isn't any deferral opportunity. But there will be slides that will impact you, which we'll get to. Okay, for the sole proprietor here, I think this is an excellent slide. Maximize capital cost allowance on assets. You've probably heard the saying that as a business owner, you should try to buy your capital asset purchases before the end of the year, and actually close to December as much as possible. The reason is month's worth of depreciation, or what's known as capital cost allowance, even if you own the capital asset for a day or a few weeks, so long as it's owned by the year end of the company. So if the company's year end is December 31st, 2014, and you went to Shoot Your Shop and bought a Mac computer on December 30th, that qualifies for 6 months of depreciation, even though you only owned it for a day. Okay? So that's why I'd recommend trying to buy assets closer to the end of the year. Can we go to the next slide, please? Deferred disposition of depreciable assets until year end. Okay. So if you have an asset that you've depreciated on your books, maybe it's a car, or maybe it's a high-end piece of equipment, and you decide to trade it in or sell it for an amount that is more than the book value or depreciated value sitting on the company's account. And in that case, you're going to have what's known as the concept of recapture. Recapture is the difference between the amount that you sell it for or you trade it in for and the book value or depreciated value on your books of account. That excess or difference is included in the income of the corporation or of the sole proprietor in the year of sale. Okay, so what they're saying is, if you're going to sell an asset for more than what it's worth on the books, sell it after the year end because you don't want to pay the taxes now. Okay, increase business expenses reasonably. So if you have repairs to make or you want to enter into an advertising program, there's some purchases that you can legitimately make because you need the stuff, then consider making those purchases at the end of the year as to reduce the taxable income of the company. I do want to make one point here is that you can't enter into, let's say, an advertising contract for all of next year and pay down $20,000. That's considered a prepaid asset, and so you can't deduct the entire payment at once. You have to deduct the payment over the life of the contract. Otherwise, everyone would enter into 5-year-long contracts at the end of the year and claim the expense for the entire amount for the whole 5 years in the current year end, which isn't fair. Okay. Again, are we in the last slide here, Hui? Yeah. Okay, so just to recap, really effective tax planning is absolutely important. It'll help you save your hard-earned money and minimize your tax bill. I appreciate you all listening. We're about 5 minutes under, which is good. I'd like to open up the floor to questions. Were there any questions, Hui, that we have not captured? Okay. Does an asset bought from a family member have to be at fair market value? Yes. So it's probably difficult to get an appraisal report if it's a piece of equipment that's not worth a lot. So I would check on Google or Kijiji or on Craigslist to find out what a similar piece of equipment would cost and use that as the sale price. And then just produce an invoice for the purchase of that equipment. Is it better to take CCA from a building or not? If so, when you sell the property, you will pay a lot of capital gains. Is that right? By way of background, I have an 80-unit apartment building in Ohio, a building in Canada, and several other smaller properties in Canada. So I'm answering this question from an accountant as well as an avid real estate investor in the United States and Canada. I am a big fan of claiming capital cost allowance because it gives me a deduction today and minimizes my tax bill today. That's real money in my pocket that I could use to reinvest or pay down some of my debt against my properties. You're right, there is a disadvantage is that in the year of sale, any CCA or depreciation claimed in prior years must be included in your taxable income in the year of sale. So you might say, well, that doesn't make any sense. Why would I claim depreciation all these years and save tax just to have to pay that tax savings back to the government when I sell? Well, it comes down to the time value of money concept. $1 today that you save is worth a lot more than $1 that you pay 10 years down the road. The other question is, I've received a 1042S for a harness horse I am racing through in America. Okay, I don't know the answer off the top of my head. I'll look at the answer and I will get back to you. The family trust gets proceeds from selling common shares of a holding incorporated. The trust is distributed Let me read this out loud. The family trust gets proceeds from selling the common shares of a holding corporation in 2014. The trust distributed the proceeds to one beneficiary in 2014 with the T3 issued to this beneficiary. How should the capital gain be reported as a family trust in beneficiary's personal tax filing in 2014? So Anna, the trust can first of all have to include the capital gain in its income, half of which is taxable, but the income of the family trust is reduced by the amount paid out to the beneficiaries. So for family trusts, we always recommend that the family trust disperse all of its income in the year to a single beneficiary or to multiple beneficiaries. Then on the T3 slip that the beneficiary receives, there's a box that will say amount of capital gains allocated to you in the year. So when the individual prepares his personal tax return, he'll enter the data from the T3 slip on his personal return. If I've separated from my husband during 2014, can I file separately, or does it depend on the date of separation? If you are separated on December 31st, 2014, you file as separated. Not the family member be treated as a subcontractor and provide just one invoice. I believe we answered this question already, and the fact that payroll taxes would be applicable. Can a director be a subcontractor and corporation issue a T4A at the end of the year? You can pay director fees. Those are different than subcontract fees. Director fees are also subject to payroll taxes, and I believe a T4 has to be issued, but I'll verify that. What I would strongly recommend is avoid schemes that try to avoid payroll tax, like through management fees or service fees, because the CRA, I know from experience, is going to come back and recharacterize those fees as salary, on which source deductions will be applicable, and if you didn't make them, you're going to get a lot of penalties and interest. There's really only two ways that I think you can pay yourself. One is a dividend, one is a salary, so you have to pick one or the other. Please confirm that the corporate taxes are due on company taxable income, even if up to 30K is taken out in dividends. Yes, dividends are not an expense to the company. You could pay $1 million in dividends or $1. It doesn't matter. The corporation is liable for tax on its taxable income, irregardless of the amount of dividends paid. Hasn't the CRA closed the gap between dividends and earned income to almost zero? They did change the rates on ineligible and eligible dividends, closed the gap, but the biggest savings that you will get now when paying dividends as opposed to salary is that you're able to save paying those nasty CPP premiums of up to $4,000 per employee. Bonuses are considered an expense. Yes, bonuses are considered an expense. That's right. Keyman insurance can also be recorded. Yes, Keyman is tax deductible. It is, yes. Any other questions here that we haven't covered? I do have some slides on the Ontario pension plan. If you could send me an email, what I'll do is I'll forward those slides that I conducted in a previous webinar, and you can read up on how much the rates are and what the rules are. As a non-resident having a business in Canada with a source of income from the U.S., so as a non-resident having business in Canada with source of income from U.S. would be taxed in Canada. So under the Canada-U.S. treaty, business income is taxed in the country where the permanent establishment is situated. A permanent establishment means a fixed place of business. So if the fixed place of business, like an office, is situated in Canada and the Canadian company makes sales to the U.S., then those sales and the resulting profits are attributed to the Canadian permanent establishment and taxable in Canada only. What would be the best tax planning for a doctor with a high income, $300K per year? That's a very good question, but there's just so many points that are beyond the scope of the seminar. I'd really have to sit down with you, understand your entire situation, and make recommendations for improvements. I'll be selling my house in the USA in 2015, which is currently a rental property. I'll be selling it for less than I paid it for, so I won't be making any profit. Yeah, you still have to pay 10% withholding tax, and there's a waiver that you can get. I believe it's Form 8288B. That's 8288B. We prepare those. It has to be filed within 90 days of the purchase and sale agreement date for it to be processed, and that's the only way that 10% can be avoided. When you file your 1040 NR, which we prepare, U.S. returns by the way, you can recover any excess taxes that were withheld or paid. Is the $35,000 benefit dividends based on the actual dividend or the taxable? It's the actual dividend of $35,000, not the taxable amount. Would work for an adult child to claim income without regular payments made to the child from a disabled elderly parent? Would it work for an adult child to claim income without regular payments made to the child from a disabled elderly parent? If an adult child was forced to quit their job and take care of disabled parents after a stroke but never kept any books, is there any way to have the disabled parent's taxes and the adult caregiver have an employment tax reduction accepted by CRA? I'd have to look at that question. It's a very good one. If you could email me after the seminar, I'll come up with an answer for you to see if there's something that can be done. What is the procedure to pay family members in other countries? It depends on the country. Dividends are one way if they are a shareholder. According to Canadian legislation, 25% withholding tax on dividends paid to non-residents. That withholding tax can be reduced by the applicable treaty between Canada and the country where the shareholder is receiving the dividends. Another way is to pay a salary. You would do it in the same way that you pay salary for a Canadian resident, like through normal payroll deductions. And then that non-resident would file a T1 non-resident return to report and pay tax on the salary received in the year. Can a professional corporation pay dividends to family members with non-voting shares? Yes, so long as the attributes as contained in the Articles of Incorporation specify that the non-voting shares are entitled to receive dividends. Usually there's a clause that says that dividends are payable on these non-voting shares at the discretion of the board. So long as that clause is there, dividends can be paid to a non-voting shareholder in a professional corporation. My son has taught senior kindergarten for 2 years where he took up a residence. Does he need to file a Canadian T1? It depends on the tax treaty between the country where your son is resident in, so I'm assuming Canada and that other country. So if you email me the facts of the situation after this seminar, I can provide you with an answer.
South Korea.
Oh, he said South Korea, SK. My son has taught in SK for 2 years where he took up residence. Oh, I see. Yeah, so we do have quite a few clients actually that move all over Asia, South Korea in particular, because it's a booming economy. If he did maintain a home in Canada, if he doesn't have a spouse in Canada, and if he doesn't have any dependent children in Canada, then he's likely a resident of South Korea, and so his Korean income would only be taxable in SK, and he would file a departure return for the year that he left Canada. What is the impact on recapture of depreciation in the U.S. on the tax-deferred rollover when selling and then buying? I think you're trying to talk about sort of the rollover or exchange rules. If you could email me, Tom, after the seminar, I'll look into it and give you an answer. If a primary residence is sold and then 1 year later, after the bank interest tax on the house proceeds is paid, and then the person's main residency is a non-tax treaty country, do they have to pay an expat tax, departure tax? Okay, well, can you give me all those facts maybe after this seminar? I really need more information, but if you put it down in bullet point, I'll look at it and I promise I'll give you an answer by email. Canadian citizen working in the U.S., should they pay taxes in both U.S. and Canada? If you are a U.S. citizen or a green card holder, doesn't matter where in the world you live, the IRS or Uncle Sam is going to tax you. According to the Canada Tax Treaty with the United States, you're a resident of the country where your permanent home is situated. So if your permanent home is situated in the U.S. and not Canada, then you'd only be liable for tax in the United States. However, if your permanent home is situated in Canada while you're working in the States and commuting back and forth, you'll still be liable in Canada on your U.S. sourced income for tax in Canada, but you will get a foreign tax credit for the U.S. taxes paid. Okay, we'll just wrap up in the next 5 minutes, so I'll just take a couple more questions if there are any. And as I said, would you mind just putting my email in the chat box? You can feel free to email me after the seminar. I will answer your question. So you send me an email and I promise I'll get back to you. Sean asked, should I incorporate or not? What's the determining factor to do this? From a non-tax perspective, it's liability. If you're not willing to take any risk because you're afraid of being sued and you want to protect your personal assets, then certainly incorporation will provide you with limited liability protection, so your personal assets would not be at risk in the event of a lawsuit. From a tax standpoint, you should incorporate when you have the ability to save money inside the corporation and not withdraw all of the corporate profits to yourself personally to pay for your bills, meaning you're making more money than what you need, then incorporate. Are legal expenses deductible for negotiating a severance payment for an ex-employer? Yes, they are in that circumstance on your personal tax return. Legal fees paid to collect compensation, employment compensation from a former employer are tax deductible. Is there an expat tax for house residence sale to another country? No, departure tax is not applicable on real property situated in Canada, whether that's a primary residence or not, if you move to another country. I think that's what you're asking. Can we use the $800,000 capital gain exemption? No, it's not the same as the personal services business. What the capital gains exemption means is that a shareholder of a private company in Canada, so long as that shareholder is a resident of Canada, can receive up to $800,000 completely tax-free on the sale of his shares in his company. So let's say I start a company, the shares are basically worth nothing because it's a startup. 3 years later, I get an offer for $1 million and I'm jumping up for joy and I sell my company shares for $1 million. In Canada, if I'm a resident and the Canadian company is situated in Canada, generally speaking, you don't have to pay tax on the first $800,000 of profit. So I'd only be taxable in this case on $200,000 of the entire $1 million, not that. Okay. We have a question from Andrew. Okay. Last one I'll answer, and then we'll basically, please do email it to me. What is the income tax bracket for non-resident on business income in Canada? It's the same rate, and the marginal rate for a non-resident and a resident is the same. The only difference is that residents are entitled to a lot of personal tax credits that non-residents don't get. Okay. All right. Thank you all for attending the seminar. I really appreciate you taking the time out of your busy schedules. Hui will send out the webinar for your future references along with the link with the audio and video recording. If you have further questions, please send me an email. I appreciate your time and have yourselves a wonderful weekend. Thank you.